I would like to officially welcome all of you to the Unaccountable Pharmacy, Accounting and Tax Strategies for Retail Pharmacies. We have Ollin Sykes and Scotty Sykes presenting today. And throughout the presentation, you're all on mute in the audience, but we would love to see questions. So if you have questions for Ollin and Scotty at any point, we're asking that you please use the chat panel. You can use the chat panel on your GoToWebinar control panel. And you can choose to send it to the organizers and panelists or allow the entire audience to see the question. So please at any point feel free to ask questions, and then mainly Ollin and Scotty will be answering them after the presentation point of the webinar. And with that, I turn it over to Ollin and Scotty.
And we appreciate very much you being on the call today. This is Ollin Sykes, and Scott Sykes will be talking in just a moment. This is our first live presentation this year on a very important topic, and with that said, I'm going to hand it over to Scotty in just a second. We're going to try to run this in about 25 minutes and answer some questions. And as Rachel has mentioned, if you'll please type those into the chat box, we'll be happy to answer as many of them at the end that we can. So go ahead, Scotty.
All right, appreciate being here. Thanks for joining in today. Today we're going to be talking about the unaccountable pharmacy, which is a lot of pharmacies out there in today's environment. But we're going to quickly touch on the importance of quality accounting and why that's important to you. We're going to go over the balance sheet and income statement, that kind of thing, and then we're going to touch on some tax strategies for you guys. Accounting is fundamental to all business. You have to understand that, especially in pharmacy, it's as important as ever to have good quality accounting with reimbursements the way they are, in the environment you're working in. You have to have good accounting and understand where your pharmacy stands, where it stands compared to your peers, and what issues there are that are hindering you from succeeding. But it's the foundation. It provides health and efficiencies, so you know what's going on. It gives you an understanding. It allows you to be proactive. Towards the end of the year, you can be proactive with your tax strategies instead of waiting until right now to see what you can do for 2016. It's pretty much too late for that. So having that accounting in place, you're already looking ahead to the end of the year come fourth quarter or summertime, basically. It allows you to identify trends because you have the good accounting in there each day, and you're able to see those trends develop. And it provides integrity and structure, and you have to have that today. The typical accounting system of yesterday, the accounting industry is changing as well, and with it, they're moving away from paper-based manual processes, and everything's going to the cloud, technology-based, technology-driven. So you're getting efficiencies using the cloud and using technology. So instead of manual processes such as handwriting checks, sending your thumb drive across the street to your CPA once a month or quarter, or even at the end of the year, none of that's really done anymore. So the accounting world is changing. You should change with it, as long as in addition to the pharmacy that you're working in. But like I said, everything's moving to the cloud. You've got daily real-time reporting using these cloud-based technologies. It allows you to be proactive. Of course, it gives you tax planning opportunities because you're keeping up with your accounting each day, every day. So now we're just going to dive into the balance sheet. The balance sheet is the snapshot in time. When you're reviewing your financial statements from your CPA or whomever it may be, you want to start at the balance sheet. You have to understand the balance sheet before you just jump right into the P&L. It's extremely important. A lot of the balances on that balance sheet affect your P&L, so making sure that balance sheet is tied in and reconciled on each line item is critical to having a good P&L and accurate P&L. Integrity in those numbers is paramount. If inventory, for example, is $100,000 off, your P&L is going to be $100,000 off. So having integrity in all those numbers, checking account, your fixed assets, all your notes, allows you to have integrity in that P&L. So when you review that P&L, you know what you're looking at is accurate. Generally, for pharmacies, it's on the accrual basis of accounting, and that means you're reporting your third-party receivables, you're reporting your accounts payable, and that should also carry over on your tax return as well. A lot of times we see issues where that is not being reported on the tax return, which is incorrect. In this slide, we just have a sample balance sheet here, asset section. Making sure your checking account's tied in, you've got your AR third-party insurance, you're using some kind of reconciliation service there to keep up with that balance and manage that, and knowing what you're owed and making sure that what you are owed is you're collecting it. If the AR third-party systems also allow you to identify, maybe carriers that are slacking, that are paying 60 days instead of 20, 30 days. So using an AR system is very beneficial. And not only that, managing that AR third-party reconciliation service that you may be using is very important as well. Making sure you have your customer accounts receivables in there. And then we're going to head to inventory. Inventory is very important. It is probably the most important piece on your balance sheet. It ties right into your cost of goods, and it also ties into your, of course, your gross margin. So having a very tight inventory figure on the balance sheet each month is going to give you an accurate representation of your gross margin on the P&L. And gross margin is extremely important. You want to know what your margins are. You want to know how you're doing compared to your peers on the margins. So the amount of information you can gain from having a good inventory and good margin is very important. Hopefully you have a perpetual system in place. That perpetual system, you can go in and at the end of the month pull a report, and hopefully your script system you're using allows for that. If not, you need to probably consider getting a perpetual system in place, because managing that inventory is very important.
And Scotty, along with that inventory, you want to make sure that you're doing some type of cycle counts on some type of periodic basis if you do have a perpetual system. And the cycle count is essentially where maybe if you got 4 shelves of script items, you'll count them maybe once a quarter. So maybe you get full counts of each of the shelves once a year. We typically are not worried about OTC items, out front items. Typically they're insignificant in terms of dollars and cents. But as Scotty has mentioned, the inventory, the control of the inventory is of paramount concern in determining the right gross margin and in turn the right net income. And if your inventory is all $50,000, $100,000, your margins are skewed. You cannot really tie in your margins to your peers. As you probably know, the NCPA norm is around the 22.5% range. The latest NCPA Cardinal report. That's if you're just a straight independent without long-term care, compounding, etc. But the inventory is probably, that and the third-party receivables is probably the most critical numbers that we see on the balance sheet, and making sure that these are tied in on a regular, continuous basis. So with that, Scotty, I'll pass it on to you.
And not only that, the inventory also, if your margins are off and your cost of goods are off, that's going to impact the bottom line. So you may be over-reporting net income for the year, or maybe even under-reporting net income for the year. You want to make sure your fixed assets are tied in. That's pretty standard. Hopefully your CPA keeps up with that. There are tax advantages when it comes to fixed assets, which we'll dive into later. The other assets, just making sure those are tied in and reconciled each month, also impact your P&L. So it's very important you also are taking care of those.
Yeah, and if you've previously purchased script files, for example, or goodwill in another pharmacy transaction where you bought assets, you want to make sure you're amortizing that appropriately. Typically, for tax purposes, that's over a 15-year period of time straight line. We'd like to do that on a monthly basis with amortization, as you would with monthly basis for depreciation. We'd like to keep that both of those items tied in to these subsidiary schedules on a monthly basis. So again, the financials we're looking at monthly with our hundreds of pharmacies and clients we're dealing with, we make sure they're tied in on an ongoing, regular, and continuous basis.
We'll head into the liabilities now. Accounts payable, making sure you have the wholesaler in there. At the end of the month, you have all your payables. That gives you an accurate depiction of what's going on. You've got all the expenses that are showing on the accrual basis of accounting. Making sure you have your credit cards reconciled and tied in. I know the other day here in our office we reconcile that credit card every day, and we found a erroneous charge. We brought it up to the client right then and there that day, and sure enough, it was $10,000 that was erroneous. So you know, you're able to catch those things by implementing a daily accounting. Also, if you have several entities, you want to make sure you're doing the intercompany transactions and transfers correctly, so you're breaking out between which store is which as far as expenses. And also, you know, sales tax, and more importantly, you've got on here current portion of long-term debt. So you want to make sure your debt is reconciled each month, that you're showing the interest and principal portions correctly. Not only does this impact your P&L, which is extremely important, making sure you know what's going on in your pharmacy, but it also allows you to understand key ratios you need to be tracking as well, such as current ratios and whatnot. But we'll dive into that here in a minute. But so the balance sheet is very important because, like I've said, it gives you that accurate P&L. It allows you to be able to plan and proactively understand, know what's going on in your pharmacy, and that's just very important in today's pharmacy environment. And then the equity section, you know, you just want to make sure your retained earnings are tied in each year, tied into the tax return. A lot of times we see accounting files where there's a tax return with the one set of retained earnings, and then we pull up the accounting file and it's a whole nother retained earnings balance. So that tells us, hey, there's two accounting files going on here. They're not married to each other. So one file is completely wrong, and what you're looking at is pretty much worthless. So making sure you're tying in the retained earnings, whatever adjustments your CPA or whomever are making, you're getting those into your system, and you have a good foundation there in your equity section. The P&L, the profit and loss statement, so it's just your revenues and expenses. It's generally shown on a monthly or quarterly basis. We like to show it monthly here at Sykes & Company. Very important to be tracking this day in, day out, and on a monthly basis particularly. And it shows your income or loss for the period. On this slide, we've got our sales and costs of goods. So your revenues, you know, if you're keeping up with your point of sale reports and reconciling your bank accounts daily, you're keeping up with your sales daily, that's pretty straightforward. Your cost of goods, that, like I said, that ties right into your inventory and your accounts payable from your wholesaler or any other wholesaler you're using for your cost of goods. But any big change in that inventory figure is going to impact that cost of goods. So making sure that inventory is tied in is extremely important, because you could show 18% gross profit there, but if you're $100,000 off, you know, that percentage is going to be off, and you're going to be reading your numbers, and you're going to be off in your analysis. Expenses and rebates. So I couldn't show all the expenses here, but I did want to highlight your wages up top here. You know, wages outside of what you're buying, your cost of goods, wages is your biggest expense. So if you're having some trouble and you've got good accounting you're looking at, look at your wages. Look at what percentage of revenue your wages are. Generally, the NCPA norm is about 11.5%, 10.5%. We like to see it under 10%. The most successful pharmacies are in the single digits as your wages as a percent of revenue. So if you're having some major cash flow problems, I mean, you want to start here at your wages and see what's going on, because we've seen pharmacies come in our door and they have 18% wages as a percent of revenue, which is pretty much their entire gross margin. So focus on your wages, streamline whatever you have to do, whether it's cut hours on Sunday or whatnot, but make sure your wages are where they should be.
And let me just comment on that, Scotty. We see a lot of pharmacies who tend to spend a lot of time on areas outside of gross margin and wages and benefits. They tend to maybe spend 80, 90% of their time reducing costs in items that may not make a lot of difference in terms of numbers of dollars or percentages of your total gross accrued revenue. My theory is if you'll spend 80% of your time on what your wages, your benefits are, your health insurance, which most pharmacies are paying about 50% of the health coverage for the employees only, if any benefit programs that you have, and the remainder of that time on how well you buy. How well you buy is the single most important aspect of your P&L. But if you'll spend your time on those areas, then your bottom line net income will have a chance of recovering in today's environment where reimbursements are very, very tight. So don't spend your time on advertising. Don't spend your time on other expenses. Spend it on those areas that are going to make a huge difference. And as Scotty mentioned, our high performers, you typically are seeing their wages are under 10% of gross accrued revenues, and that includes owner salaries. Typically, we see owner salaries no more than 3% of total gross accrued revenue. So that means about 7% for other in order to maximize your numbers on the bottom line. And on the bottom line, we're typically seeing about 4 to 7% of gross accrued revenues pre-tax. So and notice I'm saying gross accrued revenues. That's taking third-party receivables into consideration, which you should in order to be able to get a realistic view of what kind of money that you're earning during a particular reporting period.
Right. So gross sales includes your AR third party, which is on your balance sheet, includes all sales, and the wages are gross wages. So it includes owners and all employees. That's what that would be. All right, going on down to the other income. You know, we like to show rebate income separately. We like to break that out. That's just another data point for us and for us to analyze the P&L and what's going on with the particular pharmacy and compare it to the peers. But just breaking out that extra rebate income and showing it as other income rather than against cost of goods just gives us that extra data point to analyze what's going on in the pharmacy.
And to stay on top of a question here, yes, Jeff, that salary figure of 10% or less includes all employees, pharmacists, techs, clerks, bookkeepers, delivery drivers, owners, the whole shebang.
Okay, Ollin, you want to talk about the ratios?
Okay, the reason we put this in here is that we look at your current ratio, which is the current assets less your current liabilities, which is your current assets are your cash, your receivables, and your inventory, essentially, over what you owe in the next 12 months in terms of accounts payable and maybe debt that's due in the next 12 months. We look at that as probably the major liquidity ratio, probably the most important ratio on your balance sheet. Most pharmacies we're dealing with have that current ratio of about 2.5 to 1, meaning they've got $2.50 of cash, receivables, and inventory for every dollar of short-term debt they have. The NCPA Cardinal report is showing about 4 to 1, but we don't typically see most pharmacies having that much liquidity. Anytime you get under 2 to 1, that would suggest you're going to have a problematic situation. And anytime you're over 2.5 to 3 to 1, you're probably going to be in much better shape in most other situations. The quick ratio is just another liquidity ratio that's not used as frequently as current ratio. Your equity to assets is a ratio taking your equity, which is really what you've got in the business in terms of retained earnings and capital, as a percentage of all your total assets. The NCPA norm for that's about 40 to 60%. We talked about payroll as a percentage of revenue, about 10.5%, hopefully. And here's another item you don't see too frequently. Total expenses as a percentage of revenue. Most pharmacies, once you X out depreciation, amortization, payroll-related costs, you've got about 5 to 7% of other types of expenses left on that P&L. So as I mentioned earlier, while those other expenses are important, sometimes there's not a lot that you can do about your rent. There's not a lot that you can do about several other expenses that maybe are under 0.5 of 1%. So you need to kind of look at those in the aggregate. But we use these ratios and key performance indicators as kind of quick and dirty. Where do you stand on your balance sheet and your P&L statistics?
And just going back to that, having that good accounting, that balance sheet tied in, allows you to get good ratios, allows you to analyze accurately what's going on in the pharmacy. Tax strategies, again, starting with the fundamental accounting is very important. Without that fundamental accounting in place, you're not able to be proactive with tax strategies. You're waiting until now to figure out how you did last year or whatnot. So having that fundamental accounting day in, day out, each month gives you the opportunity to know exactly how you're performing, what you need to do if any, to mitigate any income taxes. And implementing strategies during the year instead of waiting till afterwards is is crucial. Retirement plan options. There's several retirement plan options available. Making sure that you have the right plan for your needs is extremely important and can be a very beneficial tax strategy. Allows that deferral of tax. There's simple IRA plans, which are pretty minimal. Most pharmacies could benefit using a better plan than a simple IRA. You've got a 401k safe harbor, which is probably what most folks have. In addition to the safe harbor, you have a profit sharing component to that. You can have a profit sharing component to that. That allows for additional 401k monies to be deferred into your retirement accounts, which can be a nice tax strategy. If you are in a certain if you are a certain pharmacy with solid cash flow, you're more mature, you're an older owner, perhaps a cash balance plan may be appropriate for you. Cash balance plans are really a big boost to the safe harbor profit sharing, meaning you can put in way more money and defer way more money into those accounts, showing that expense on your profit and loss and decreasing that net income balance and therefore tax.
As an example, some of your cash balance plans allow you to put up to $265,000 a year into them. These are very complex plans that need to be planned appropriately. Be careful with any and all these plans in letting a salesperson sell you something in a completed package where they're packaging both the administrative costs, the investment asset management into that, as well as the administration. Typically, these firms will spin off the administration to other areas, and they're really just looking at the management fees, and you need to be very careful what management fees you're paying in today's environment, especially when you've got exchange-traded funds and index funds where you can pay 30 or 40 basis points versus 1 to 2 to 3 percentage points management fees. We see a lot of that. We have no conflicts of interest, and that way we can talk about these very openly. But we see a lot of that with pharmacists who don't really understand the details of these kinds of plans. And just a quick example, I'll go through this with Scotty. If you got net income of before retirement plan of $500,000, and let's say you have a $350,000 cash balance accrual, that leaves you $150,000 in net income. You're saving roughly $140,000. Your tax savings at 40% on $140,000 is very significant. So these are things that you actually have to set up prior to year end. But in looking at 17, these are things that you probably want to take a look ahead. And in spite of time here, I'll kind of flow right into some other things that we're seeing in the industry. We've got a lot of pharmacies that are looking today at conservation easements. Congress made this much more apropos last year. It's been in the law for the last 30 years or so. Congress made it much more favorable in December of 15. There have been several industry experts that have spoken at some of the industry leading shows at NCPA, PDS, and places like that about conservation easements. We have a lot of pharmacists that are diving into this. This is generally where you can get a substantial write-off from an investment into a limited partnership. You're limited to 50% of adjusted gross income with the charitable contributions. They do have a certain amount of risk to them associated with appraisal risk and reporting requirements and due diligence, but these are things that some of the high-powered pharmacies are doing to mitigate taxation and become a tax replacement strategy to a certain degree. Scotty, you want to talk about DPAD?
Yep, sure. The domestic production activities deduction, pretty much if you are a compounder and a good amount of revenues come from compounding, this would probably apply to you. It's important to have that good accounting in place because you're able to separate your compounding revenues and your compounding expenses, because you do have to report those separately when claiming this deduction. If you've got that accounting in place, it's fairly straightforward calculation, and the deduction's equal to 9% of your domestic production activities income, which would be your compounding income or your taxable income. So it's equal to 9% of that, or your compounding income, or the taxable income. There are wage limitations, and before you just say, I do some compounding, this sounds good to me, you do want to consult with your CPA to see if it's worthwhile, the effort. to make sure it works for you. But this is a valid tax strategy. Now, with that said, I know we might touch on some Trump tax updates for this year and forward, but this one would be, I believe, on the chopping block for the tax updates that may be coming for 2017 and beyond.
This one would also apply probably if you do compounding to 5 or 10% or higher. If you do 2 or 3 percentage points of your income in compound, it probably the cost of doing this probably doesn't exceed the benefits. But it's amazing. We'll run into some compounders from time to time that 20 to 30% of their revenues, they never knew anything about this. You can actually go back and amend your returns for 2 years if you don't know anything about this, or if no one has ever brought this to your attention. So this is something we very commonly use and see.
Section 179 depreciation. This allows to equipment write-offs pretty much in the first year. For example, if you've got enough net income to write off and you put in a robot, say at the end of 2016, you may be able to write off that entire robot and decrease your net income as a result. It's equal to up to $500,000 for 2016. New and used equipment qualifies. The key thing here, it must be put in use. Now, with the Trump changes that may be coming down the line, this may be wrapped into those changes. So it's eager to see how everything plays out. But right now, this is a good valid strategy if you have equipment needs in your pharmacy. But again, it has to be put in use. You have to be able to use it in the year that you're taking the depreciation.
For those of you who've installed systems, whether it be new script systems or new robots, whatever the case may be in 16, you may have signed a capital lease. That's where you basically pay a little down, pay an X dollars over 3 years or 5 years, and then $1 at the termination of that. That's considered a lease financing contract and as if you bought it. And that qualifies for the Section 179 depreciation if you put it in use, filling scripts in 16. So be aware of that.
That's correct. Here's just a quick example. If you have net income of around $200,000, you buy a $150,000 robot, you're able to write all that off, Section 179. Net income after $50,000, tax savings of about $60,000 with an after-tax cost of $90,000.
Okay, and we got coming up closely on the time, but I've got a question here I want to get into, and we encourage you to type any other questions here on the chat box here. Jeff is asking about the lag time between PBM reimbursements and the date billed, along with the delay in paying your wholesaler. How can you accurately determine your cost of goods sold and wholesaler performance? Well, if you keep a perpetual inventory system, your inventory numbers are going to be what they are at the end of the month. Keeping in mind that if you order on the last day of the month, your system is updated on that order, and it's included in payables, that needs to be included in your inventory. Your third-party receivables, you should be able to go to your third-party reconciliation system, whether using Elevate, NetRx, Provider Pay, or somebody like that, to pull down your receivables that are due on the last business day of the month, keeping in mind that anything 60 days and under most likely will be received. Anything over 60 days or longer is problematic, and you need to get on top of it very quickly. But that's where we typically pick up our third-party receivables. You may also have counter or local charges from copays or OTC items that you're charging internally, but you've got to take your receivables, your inventory into consideration. If you don't have a perpetual inventory system, we'd like you to have 2 physical counts twice a year of your script area so we can tie down inventory numbers as tight as we can. But once we know what that gross margin figure is, Jeff, we can determine what your gross margins are, and we always have to consider how your rebates are accounted for. And if your numbers are not close to where the NCPA norm is, you know you've got a problem, and you might need to be talking to other buying groups or wholesalers, as the case may be, to answer that particular question.
And I'll just quickly add to that, making sure that balance sheet being tied in, and as he was saying, that inventory or payables are tied in, and you're reporting on the accrual basis of accounting. That's going to give you that information you need.
Correct. And Mark has a question, do you have to be licensed as a manufacturer to take advantage of that domestic production activity deduction? Mark, the answer is no, you don't, because the IRS considers a compounder a manufacturer for IRS purposes, not for FDA purposes, so don't freak out. It's for IRS purposes only. So you're considered a manufacturer. That's what allows you to take that domestic production activity deduction, Mark. And then Shree's asking, how do we deal with intercompany transaction if a person owns 2 companies? It's very simple, Shree. We need to track payments from one entity to another. If you loan money from one company, one pharmacy to another, on one set of books is a receivable, on another set of books is a payable. It's not a deduction, it's not income, it's a balance sheet transaction. That's how we track those intra-company transactions that you may have.
Right, and that goes for any insurance you may have. If you're paying the insurance all through one entity, you need to be at the end of each month adjusting journal entries to break that out between the intercompany, and that's very important.
There's another question asking, do we have a recommendation for retirement plan? And the answer to that would be we would. I would rather you call us direct on our phone afterwards. We'd be able to talk about that more directly. Another question here is about considering substantial amounts of buying group wholesaler rebates and how this affects margins, how is that considered. Obviously, whether you're going through a buying group or a wholesaler, your rebates, all of that affects what your gross margins are. We have some pharmacies with maybe 3 or 4% rebates. We have other pharmacies with 10 to 12% rebates. A lot of it depends on volume of purchases. It depends on volume of generic purchases versus brands and a whole host of other issues. But you got to look at all those particular issues. If you do a Google of the top 10 buying groups in the country, that's probably where I would start taking a look at. We do have our preferences. If you want to call me on the phone, I'd be happy to talk about that directly. There's another question here about also what percentage of wages should be non-pharmacist salary. I don't track it necessarily like that, Mr. Peter. We're just tracking owner salaries at 3% or less and total salaries at 10.5% or less. I think you've got to take a look at the hours that you're open. And Scotty mentioned this earlier, but I think a lot of times you can look, if you're open at 8, maybe you need to be open at 9. If you're open at 8:30, maybe you need to be open at 9:30 in the morning. And maybe you need to open your drive-up window that hour. You might be surprised. We've seen pharmacies save 15 to 20% of payroll a week, but just altering just a few hours, either in the morning or in the evenings, or cutting out Saturday hours after 2 o'clock, not having Sunday hours, you can make a dramatic change in your payroll. And with the script systems, you can generate reports to show you what kind of volume of revenue you're doing per hour, and I would suggest you take a hard look at that in your systems to be able to maximize what payroll that you may or may not have during certain hours. If you have any other questions, you can feel free to type them in. We just had a few more minutes if you'd like. I don't see any other questions. Scotty, you know of any of the points here that you wanted to touch on that we missed?
No, I think we covered a lot, and you know, it's been great to be here. Again, if you have any further questions in the future, feel free to reach out to us at any time.
Yeah, and I will say on this last slide that's showing here, you can see these are our direct phone numbers to our desk. Feel free to call direct. We'll pick up the phone and answer. If you go to voicemail, we'll return your call. You can see our Twitter handles here and our email addresses and our website. I want to mention that we have hundreds of videos on our website that I would encourage you to take a look at. If you haven't had a chance to go to our website and to look at pharmacy industry specific items on our website, I think you might be amazed at the kind of information that's available out there to you and free. All our firm does is work with hundreds of pharmacies all over the country in 6 different time zones, and we love to answer your questions and help you in any way we can. And just give us a call. And Rachel, that's all we have today.
All right. Thank you very much for presenting. Thank you, everyone who attended. We hope you enjoyed the webinar and look forward to doing more in the future.
Thank you very much. Have a great day.
Thank you.
Bye-bye.